Monday morning, folks, and welcome to a brand new episode of FinMet Mondays. Last week again was quite interesting. We did predict that the 1850 level will hold, but that didn't turn out to be true, Sunil. We saw complete follow through selling up until 1800, 1820 to be precise, and then it's held somewhere on the 1800 level, right? We spoke about how payrolls data was the main point of focus last week. And surprisingly, even though payrolls came in high, markets, gold markets, and silver markets tend to bounce back. What is the reason behind that, would you say?
The data came in very strong, in fact, much stronger than expected. Against 173,000, it came in at 330,000. Plus, there were revisions earlier. So basically, what it said was that there's a lot of job creation taking place in the US. And obviously, that was creating fears of interest rate hikes. And that's why gold was immediately after the announcement actually sold off by about $5 or $6. I think we touched a low of 1810 or so for a second. And then when the market looked through the numbers, it rebounded back to 1832. Why is that? Well, the reason is that when people looked at the numbers and said, okay, look, a lot of the job gains seem to be seasonal. Okay. And so it was to be expected that this would happen. But moreover, what they found was that the job gains or job additions were done despite the fact that the salaries hadn't gone up. So what it looks like is that the wages haven't gone up to the extent that people were expecting with this size of increase of jobs. And so the pressure on inflation is not as much as it would look like when you look at the jobs number. So there's a view that maybe the Fed will say, okay, look, this is not bad. Jobs are being created. At least it's not impacting inflation right now. So maybe they wouldn't increase it. The next Fed meeting is at the end of October. And I think unless some inflation data comes in really hot, they may even skip any kind of increase, even with this data. And so I think that realization came through. Plus, there was some profit taking. And so that's why we saw gold at 1831.
The unemployment rate as well came in slightly higher, not alarming, but around 3.8%, which has been slightly higher than what we've seen for the months of June, July, August. I think that was also one of the other contributing reasons, probably. Sunil, there's been, on the weekend, there have been developments around the Israel-Palestinian conflict. There have also been developments in the bullion markets as well. So looking forward to next week, how do you think all of these are going to shape the price action for next week?
I think there's three pieces of news which I've seen over the last couple of days, which are quite interesting and I think may have an impact in terms of the coming week for us. The first, of course, is the Israeli-Palestinian conflict has really gone to a much increased level than we've seen for the last 50 years. And the view is when the markets open on Monday morning, there will be safe haven buying. And so you may see a spike up of gold going past the 1850 level that was the earlier support. So I think that's definitely going to be a challenge in the short term because people will gravitate towards gold. The news is really not that good. It's a very, very difficult conflict. There's going to be many countries involved. So I think that's one thing which is creating a little bit of bullish sentiment in the market. But there was two other pieces of news that came out, two actually data. One is China has announced its reserves. Every month they give an update in terms of their reserves, gold reserves, and their gold reserves has gone up, I think, almost about 28 tons in the month of September. So that shows that China is rotating out of U.S. treasuries and actually getting into gold, and that'll be looked at as a mildly positive thing for gold. Moreover, what we've seen is if you look at the vault data in London, the LBMA declares data in terms of what physical stocks are being held. There's been a slight downturn in terms of the physical health, which shows that physical demand is quite strong. People are pulling metal out of London to make smaller bars maybe and sell it into the retail markets in Europe and Asia. And again, that's a piece of news which shows that there is physical support and there's some support for gold at these levels.
So, Sunil, as you mentioned, we broke through this 1850 support last week. This was the support we thought gold would hold against, spot gold, but it in fact broke through it. This is the same level now that has now turned as a resistance. Like you mentioned, that because of the geopolitical concerns, we could just see a rally up above this level. So this is definitely one area to watch out for, wherein you can see a test and a possible reversal, but there are chances that the markets might cross passes as well. Beyond the 1849 level, you have the major resistance at 1884. This was again also previously a major support, probably 2 weeks back when gold was trading around the 1900 regions. So these would be the two areas of resistance that I would point out. On the downside, as we've already established, the 1802 support continues to remain as the firm area of support. I already had estimated that this is going to be the point where there's going to be maximal exhaustion in the sell-offs, given the fundamentals that we have currently. And that kind of seems to be the trend going forward in the next week as well. But if in the
Correct.
case that we do see 1802 getting tested, then 1769, right, $30 down is where the next support level lies. So I would say these are the four levels from a more broader term perspective that players should be watching out for. Thanks, Neil. We'll see how the markets play out. But till then, thank you so much and goodbye.